Okay, so let's continue into chapter 2. So chapter 2 is really and truly, we could think of chapters 1 and 2 as really 1A and 1B. 1A being the qualitative piece, the kind of stuff you need to know, and chapter 2 being more quantitative. So the lecture covers the kind of the talking points, and then we'll kind of spend a lot of time in class working problems to kind of really get a feel for where the rubber meets the road in chapter 2. All right. Um, so system of accounts. All right. So building on what we learned in chapter 1, business transactions and events are the starting points for financial statements. All right. So you may recall from chapter 1 we talked about identifying each transaction, and the example on the slides was, Apple sells an iPhone. All right. So anytime a company provides a good or service, that's a transaction. Anytime a company receives a good or service, i.e. from another company. So if you're a manufacturing company, General Motors buys tires from Michelin, well, that's a transaction as well. All right. So that's the first step in any accounting exercise, is identifying the transactions. All right. Analyze each transaction using the accounting equation. So the accounting equation, of course, is assets equal liabilities plus equity. You should remember that from chapter 1. And so we're really trying to figure out which accounts to increase, or let me say it this way, which accounts to debit and or credit based on an increase or decrease of a specified transaction. All right. Okay. Keeping in mind that the accounting equation must balance before and after each transaction. All right. Record relevant transactions and events in a journal. So this is your journal entry. All right. So we'll do this. We'll spend a lot of time recording journal entries. All right. We'll talk about the process of posting to the ledger, and then the preparation of a trial balance. But in my class, we're going to spend most of our time making sure that we can accurately record the transactions and events in a journal, i.e., can we properly record journal entries? All right. Source documents are where you might look to determine whether a transaction has occurred and get information needed to record that. All right. And so these are just some examples. Purchase orders. All right. Checks written, and these could be checks for anything. Checks for the power bill, checks for property taxes or what have you. Bills from suppliers. Later in the semester, we'll do bank reconciliations. We'll get knee deep in bank statements with that. So these are just some examples of source documents. All right. So this is an accounting course. Newsflash. And the idea is that an account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. All right, so that's what an account is. Basically a system of increases and decreases in specified account types. All right. At any given moment, the general ledger, or GL, is a record of every single account in the system of accounting, all right, for a particular company. All right. So we need to understand what assets are. Now, I previously said assets are anything the company owns or controls. All right. So the most basic asset is cash. Companies don't exist for very long without it. All right. And so this is the order you typically see. The order in which I'm discussing these is the order in which you typically see them on balance sheet. All right, so cash would be listed first, then accounts receivable. What is an account receivable? Well, it's an expectation of future payment of cash. All right, so if I have a landscaping company and I cut grass and then bill for services rendered at the end of the month, well, if in a particular month I had done $400 worth of yards, but I haven't collected the cash yet, I have an asset. It's an account receivable of $400. All right, it's an expectation of future payment. And we have a chapter, and you might ask, what happens if I don't get paid that $400? Well, we'll have a chapter dedicated to just that. So stay tuned. You know, we'll cover that in a few weeks. All right. Notes receivable, same as an account receivable, just generally a longer term. Notes receivables typically also bear interest, where accounts receivables seldom do. So you think of, typically you want to collect your accounts receivable in 30 days or less. Notes receivables can be longer than 30 days, up to a year generally. All right, prepaid accounts. This is anything that you've paid for up front. From the business perspective, the classic example is insurance. Insurance is always prepaid. All right, supplies are an asset, and as they're used, they become supplies expense. Equipment. These are things that generally last more than one accounting year, like vehicles, cars, heavy equipment, steam shovels, bulldozers, all of that would fit into the category of equipment. Buildings, which is self-explanatory, and then land. All right. It is worth noting buildings and equipment are subject to depreciation, which is Chapter 8, which we'll get to later in this term. Let's talk a little bit about liabilities. Right. So you may remember from Chapter 1, liabilities are third-party claims against assets. In other words, generally for a liability, you're going to have to pay some cash out in the future. All right. And so they include accounts payable. So that is basically a bill that's come in but has not yet been paid. All right. Notes payable is the same principle, just a little longer term. Amount the company owes, but may not pay for, 6 months, for example. Unearned revenue, which is a liability because you've collected money in advance and you still have to earn it. And accrued liabilities, which are liabilities that have been incurred but not yet settled. There's a timing difference, which we'll get to in chapters 4. Equity accounts. So here we see pluses and minuses. these are the normal balances, which I'll get to in just a moment. Let's talk about the accounts first. Common stock. If a corporation issues stock, that's common stock. That increases equity. If a corporation pays a dividend, dividends are payments of cash, typically, to stockholders. So dividends, you see the minus here, dividends reduce total equity. All right. And revenues, which we've talked about previously, but we'll continue to drive home. A company has earned a revenue when they provided a good or a service. All right. And expenses. Expenses are the cost incurred in the generation of revenue. Expenses reduce equity, revenues increase equity, and the difference between the two, between revenues and expenses, is net income. All right. This is a chart of accounts, and it's a brief chart of accounts, but it's exactly what virtually any company will do. So every account in an accounting system has a number, and generally the number, the first digit, if we're dealing with 3 digits or 4 digits, is indicative of the type of asset. So in this particular system, account assets start with 1, liabilities start with 2, and then equities start with 300 or higher. All right. If we have a 400, we know that's a revenue, and if we have a 600 numbering, that's an expense. Now, not every system uses these. This is just offered as an example of a common numbering scheme. All right. So we want to really internalize the concept of debits and credits. So there's a good chance that you already have kind of a preconceived notion of what debits and credits are. All right. So I will ask you to check that at the door when you come to your accounting class, because it will confuse you. All right. From our perspective, debit means, if you think of an account, this is what we'll call a T account. All right. From our perspective, debit means an adjustment to the left side of the account, and credit means an adjustment to the right side of the account. All right. Now, a lot of times you'll associate credits maybe with an increase, debits with a decrease. You have a debit card, you have a credit card. All of those have meanings that are confusing if we apply them, their meaning outside of accounting, to this course. So for our purposes, debit means left, credit means right, right? And we need more information to really attach any additional meaning to that. And so here's our accounting equation again. This should look familiar, but it's expanded out a little bit with T accounts for assets. All right, so the word normal is, if we look at the accounting record, we would typically expect to see a debit balance for any asset account. All right, there are some exceptions that we'll get to, but for now, assets, we would expect to see a debit balance. And the normal balance is the side that serves as an increase for that account. All right, and we'll work through this. I'll demonstrate this and give you guys an opportunity to work through it as well. On the other side of the equals, for liabilities, normally if you look at a liability account, you're going to see a credit balance. So the normal balance for a liability is a credit, and we increase liabilities with credits. All right. Similar goes for equity. All right. We can expand this out a bit further and add more detail to the equity account, because equity is composed of common stock, dividends, revenues, and expenses. All right. So we'll note that dividends and expenses have normal debit balances. All right. And that's why they have minuses in front of them, because they reduce the equity account. Again, this is in the abstract. We will put concrete application to this in class. All right. Let's talk briefly about the trial balance. All right. So when we prepare a trial balance, it's going to look like a financial statement. It's going to look like a balance sheet, perhaps, but it's not. All right. It's just a total listing of every single account in an accounting system, and the balance, or I should say at the end, total debits in the system should equal total credits. In other words, if you subtracted total debits from total credits, you're going to get 0. All right. That's the trial balance. We'll work through this so you guys will get to see it in action. What is the purpose of a trial balance? So really the purpose of the trial balance is it's an interim step done before you prepare the financial statement. So this slide should look familiar. We saw it in chapter 1. These are your 4 basic financial statements. And I won't go, well, yes I will, because it's good to hear. But you would prepare a trial balance before you prepared your income statement. Income statement, revenues less expenses, giving you net income. Income statement, revenue less expenses, giving you net income over a period of time, most commonly a year. Statement of retained earnings. It's a roll forward, so it starts with retained earnings at the beginning of the year. You're going to add net income or subtract net loss, subtract any dividends paid or owner withdrawals, and you'll get to ending retained earnings. All right. Balance sheet. That is the accounting equation personified as of the income statement date. So if the year ends December 31st, the balance sheet's going to be dated December 31st. All right. Every single asset added up, every single liability added up, every single equity. Add total liabilities and total equity, and they should equal total assets. All right. Statement of cash flows. I went into the theory behind that in chapter 1, so we can kind of stick a pin in that because it doesn't come back until later in the term.